All right, my clock shows 10 o'clock, so I think we can get started here. Good morning. I want to welcome everyone here to today's webinar. We're going to cover financial statements for nonprofits. So today, Carrie's going to talk how to properly review and understand nonprofit financial statements. And this is going to be whether you understand financial information or not. So she's going to give you a perspective on both. So our goal today is to identify what should raise red flags and how to ask the right questions when you look at nonprofit financial information. So before we get started, let's take a minute to introduce everyone here. So I'm Tyson Moore, supervisor. Also with us today is Carrie Minnick. She is our partner and she's going to be presenting today. As a reminder, this webinar, it's live, it's interactive. So as Carrie goes through everything, I'm going to actively monitor the chat. I will answer your questions to the best of my abilities. If you have questions, use Zoom's question and answer feature. You should see that at the bottom of your screen. We want our webinars to be interactive. That's why we do them live. So feel free to ask as many questions as you need to. Also, Carrie's slides are going to be emailed out to everyone attending the webinar today. With that being said, I'll turn it over to Carrie to get us started.
Thank you, Tyson, and welcome everyone. Today we're going to be talking about nonprofit financial statements. And I know we have kind of a wide variety of attendees with us, both board members, executive directors, CEOs, and those that work at nonprofits. But this is kind of geared towards board members. However, those of you that aren't board members, I think will still find value in today's webinar. Let's start off with just a few things to note that as a board member, we do not manage the accounting. We do, however, interpret financial statements. So the goal of today's session when we look at financial statements is what kind of questions to look for, not the math of the financial statements, not the accounting. That is someone else's job. But as a board member, what are the questions that we need to ask when we're reviewing our organization's financial statements? So today we're first going to talk about just briefly about the different bases of accounting. We're going to go over the different financial statements, the actual specific statements for a nonprofit. And then I also have some questions that you can ask and some nonprofit KPIs. Now, as we go through, we're going to kind of address those questions and KPIs. And if we have time at the end, I'll go through each of those individually. However, I wanted you to have a copy of those within the slides. All right, so first let's talk about accounting. Before you are able to interpret the numbers, you need to know the rules used to create these numbers. So two organizations can do the exact same thing operationally and show very different results depending on whether their financial statements are prepared on the cash basis, modified cash basis, or the accrual basis, or what we call GAAP. So there's really three primary differences on how you record your accounting. The first is the cash basis. This is the simplest basis. Under this, revenue is recorded when cash is received and expenses are recorded when cash is paid. So this is exactly how you would do your personal checking account. So when you are paid, when you get your paycheck in for the week, then that's when revenue is recorded. When you write that check for your telephone bill, then that is when that expense is recorded. So very easy. This basis is very common for small organizations, those that don't have a lot of activity. It normally matches the bank balance unless, there's some outstanding checks or deposits in transit. However, this basis really hides some transactions. It doesn't show what you owe and what you are owed. So it really doesn't give a full picture of the activity. The next kind of step up in basis is the modified cash basis. So this is basically on the cash basis, which we just talked about. However, we're going to add a few accruals. We're going to add investments at fair value. Normally, fixed assets are recorded, payroll withholdings, and then if you have any loans. Now, these are the most common modifications that I've noted on the screen. There could be some other modifications to the basis. However, these are the most common ones. This modified cash basis is still much easier than the full accrual. And it does show a little bit more assets, what the organization owns, because not only are we showing cash, but we're adding investments and we're adding fixed assets. However, it still hides what the organization owes and what you are owed. So then we come to the accrual basis, or GAAP, Generally Accepted Accounting Principles. This is a very different basis as it records revenue when revenue is earned and expenses when incurred. This is really the best basis that shows your true operating results because it shows the entire picture of the organization. However, the accrual basis is sometimes difficult to understand just because it's not as easy as, recording revenue when received and expenses when paid. And also under accrual basis for nonprofits, it is not like for-profits. Revenues don't always match up with expenses. So let me give you an example. So let's say that you're an organization and you provide services in March. So you provide some kind of counseling or education services, some kind of services where you get paid for those services. And you invoice all of those services, it's a total of $50,000. So you send the invoices out, but they're not going to pay you in March. You provided the services in March, but they're not going to pay you until April. So also during March, you incur $12,000 of expenses, but you haven't paid those yet. They happened in March, but you haven't paid them. Maybe you haven't gotten the invoice or what forth, but you're going to pay those in April. But during March, you paid $10,000 of expenses that happened in February. So let's say, you ordered some items, you had some services provided to you in February, but you didn't get those invoices until March. So that's when you paid them. Also in March, you received notification that you're going to get a $300,000 grant from a local foundation that's going to be paid over the next 3 years. So it was only an award letter. They didn't make any payment on that grant. So if we keep these items in mind and we look at two different organizations that follow two different bases, the cash basis and their accrual basis, you can see that same transactions apply to both of these organizations. The revenue and expenses look very different. Under the cash basis, there would be no revenue that would actually be recorded during the March because there was no money that was actually received. However, you did pay that $10,000, so you would have a loss of $10,000. Under the accrual basis, though, the same transactions, you would record $350,000 in revenue, $12,000 in expenses, and have a $338,000 in surplus. So again, same nonprofit, same transactions, same month, two different nonprofits that follow two different bases of accounting, you can see very different results. So that's why it's very important before you look at a financial statement that you need to know what basis these financial statements are on. Now, when an organization selects what basis to use, they follow that basis. They don't flip-flop back and forth. But when you're looking at the financial statements, you just need to know what basis do they follow. So what we're going to be looking at today is the accrual basis. So when we look at these financial statements, there are four basic financial statements for nonprofits. The statement of financial position, which in the for-profit world is called the balance sheet. This reports your assets, liabilities, and net assets. Then we have the statement of activities, which in the for-profit world, the equivalent is the income statement that shows your revenue and expenses. Now, the nonprofit world has a statement of functional expenses. The for-profit world does not have this statement. And this shows all of your expenses allocated by function. And we'll talk about that a little bit later. And then we have the statement of cash flows, which is also in the for-profit world. So four basic financial statements that we're going to talk about today in a set of nonprofits financial statements. So every statement, each one of these four statements answers a different question. And we really need to look at these statements together as a whole, not just one statement, in order to really understand what is going on within the organization. Problems seem to happen when boards expect only one statement to answer all of their questions, or they only have one statement to review. Like, for example, they're only provided the income statement. We really need a complete set of financial statements in order to get a good understanding of what's going on within the organization. So the first statement we're going to look at is the statement of financial position. So I have a copy here of a sample statement of financial position. So when you look at your statement of financial position, which again is basically your balance sheet, it is going to be as of a certain date in time. So this statement here is as of December 31st, 2024. Now we have two columns because we have 24 compared to 23. Usually when you're looking at statements, you want to have the current year and the prior year, so that way you can have some comparison, a better understanding of where we're at last year compared to this year. So this again is as of one date in time. So only as of December 31st, 2024 are these numbers relevant. These numbers are going to change on January 1st, 2025, and these numbers would have been different on December 30th, 2024. So we again are just looking at one date, one moment in time. Again, we have 2024 and 2023. So on the statement, the top part is the total assets. These are the items that you own or that people owe to you. We have liabilities, which is what you owe to other people. And we have net assets, which is basically your retained earnings or your net income since the beginning of time. So let's dig down. Oh, one other thing here. When you're looking at your statement of financial position, if your total assets do not agree to your total liabilities plus your total net assets, your statements are wrong. You might as well not even look at them because there is something wrong. These two balances have to agree. If they do not agree, then your financial statements are incorrect. So that's something, first thing to look at there. All right, so let's dig down into assets. So when we're looking at the asset section, again, we have the assets on the screen now. The first column is 2024, second column is 2023. Usually assets are sorted in order of liquidity, which means how fast they can turn around and be turned into cash. So usually cash is the first line item on this statement. The items listed on the left side of the screen are common assets that you will see on a financial statement. These do not include all of the assets that you will see, but I wanted to go over some common ones that you would likely see in your statement. So the first one, cash and cash equivalents. I think that's pretty easy. That's going to be your checking, your savings, your money market, those types of accounts that the organization has. Next, we have contributions receivable. So contributions receivable are promises to give that a donor has made to the organization, but they have not paid those promises yet. So it could be from a foundation, it could be from an individual. It's a promise to give a contribution. They're not going to get anything in return for their payment. They just really are passionate about your organization. They like what you do. So they've said they are going to promise to give you a certain amount in the future. You might also see this called grants receivable or promises to give. They're the same thing. It's a promise to give something in the future for nothing in return. Now you'll see the word net after that. That is because when we have multi-year gifts, so let's say, again, that local foundation that gave your organization $300,000 and it's going to be paid $100,000 per year over 3 years, we have to present value discount that gift, which means that $100,000 today is not the same value as $100,000 3 years from now. So we have to do a calculation to present value that gift, and that is why it says net on the screen. You also might see a line for accounts receivable or claims receivable or government grants receivable. Accounts receivable are those payments that you have not received yet, but you are going to get in the future for some type of service or sales that your organization has made to someone and you've not been paid yet. So accounts receivable is when there's an exchange transaction. You have provided some type of service or some type of item that the person paying you is going to receive. And so they need to pay you for that service. Organizations that get a lot of money from the government might have claims that they submit monthly. So the line might be called claims receivable. Again, any type of receivable means someone needs to pay you for that in the future. Next are prepaid expenses. These are items that the organization has paid for, but they haven't been used yet. So for the most common example is insurance. So normally you pay your insurance either monthly or quarterly, or you might pay it all at once. but the period that that insurance covers is most likely not the same as your organization. So for example, let's say your organization is on a December year end, but your insurance coverage is June to June, or July 1st to June 30th. That means if you paid all of that insurance within the calendar year, you probably have 6 months of insurance coverage that you have paid for as of the end of the year that you haven't used yet. So then that goes on this line as an asset called prepaid. Another common prepaid is when you make a down payment for an event. Let's say you're having a fundraiser next year and you had to put a $2,000 deposit to hold the facility. So because you haven't used that facility yet, but you have paid for it, it's for a future period, that again goes in prepaids. Next, we have investments. So it's very common for nonprofits to have some type of investment, whether it be in stocks, bonds, mutual funds, whatnot. It's very common to have organizations that have investments. Next are fixed assets. So fixed assets are those items that your organization owns that have been capitalized as opposed to expensed. So these are going to be your land, buildings, vehicles, furniture, all types of property and equipment that normally have a useful life of more than 1 year, and their purchase price is over your capitalization policy. So if you don't have a capitalization policy in place, I would strongly encourage you to put one in place. And that just says that items that have similar to these types of items that have a useful life of more than 1 year and cost more than a certain dollar amount, it's very common to have $500 or $1,000, that these items will be capitalized and depreciated over their useful life versus being expensed. So what that means is if we buy some furniture and it's $5,000, that first year when we buy that furniture, it's going to go on our books as an asset for $5,000. And then we're going to depreciate it over 5 years, the useful life. So we're going to take $1,000. So we're going to expense $1,000 of that $5,000 purchase price each year. So that's very different than purchasing the fixed assets and expensing the full $5,000 that first year. But because that asset has a useful life of 5 years, we're going to match that expense with its life and depreciate it over 5 years. Next, we have endowment fund investments. So some organizations have an endowment. An endowment is where a donor has given money to the organization and they have permanently restricted that initial amount that they've given to the organization. The organization usually puts that into an investment account, and then they use the earnings off of that endowment to support programs and operations going forward. A true endowment is where a donor gives some money. For example, I'm going to give you $500,000 to set up this endowment. You cannot touch the $500,000. It needs to stay there forever as a permanently restricted endowment. But you can take the earnings off of that $500,000 and use it for operations or programs or whatever the donor says. So because that is set aside for a specific purpose, that's why it's split out from the regular investments. Next, beneficial interest. So a lot of organizations have investments with community foundations. And so this is basically your investment in your local community foundation. Money is put into that foundation. The foundation puts all of those funds together and invests it, and then you get a return 4% or 6%. And so that's what that is, beneficial interest. You might also see inventory. Some organizations have inventory that they sell that could be listed under assets. You might also see right of use lease assets for operating or financing. So a few years ago, the accounting standards changed. So if you didn't know, there are certain accounting standards that are set forth that require us to record accounting a certain way for nonprofits. And they said, okay, you have to change the way you record leases. So going forward, you have to look at your total lease, how much you're going to pay over the full life of the lease. And basically you put that on your books as an asset and you put an offsetting liability. Now it's a little more complicated than that with calculation, but that's kind of the gist of it, is you're putting your full lease on your books as an asset and liability. So you might also see that. And again, there may be some other assets that I haven't addressed here, but these are the most common ones. So when you're looking at the asset section of your financials, here's some things to think about. How much cash do we have? Hopefully that first cash line item is positive. I have seen it where it is negative. If it is negative, that means you have overdrawn cash. That is not a good thing. So we want to make sure that the cash that we have is positive. Now, I have been asked a question many times over the years as to whether there's a certain amount of cash that a nonprofit can hold. Legally, if the IRS requires it, no. There is not a certain amount of cash that a nonprofit can or cannot hold. However, you have to remember that you are in existence to provide programming, to fulfill your mission. You are not in existence to be a bank. So you just need to remember that. Now, there is one of the KPIs that we'll address later is the number of months of cash on hand. So when you look at how much cash you have on hand, how many months of expenses could you cover that with that? Best practices say 3 to 5 months. So that's something to look at. But also, maybe you don't have a lot of cash on hand and you have it in investments. That's fine. But when you're looking at cash, that's really what you should look at. When we look at receivables, whether it's contributions receivable, accounts receivable, any types of receivables, we need to compare the current year to prior year. Did it go up or did it go down? So normally we want accounts receivable to go down because that means we're collecting it. However, sometimes it will go up and it will jump very, very high. So for example, if you normally get a 3-year grant from a foundation, every 3 years, you're going to have a jump in your contributions receivable. Because under the nonprofit accounting, nonprofits are required to record those revenue when they've been notified. So that $300,000, not when you get it paid under the accrual basis, but when you're actually notified of the grant, that is when you're going to record it as a receivable. So you might every 3 years have a very large jump in your contributions receivable. So you need to know what's going on within your organization. If your receivables are getting higher and higher and you don't have any of those new grants, it may trigger an issue that you're having trouble collecting your receivables. And so that might be something you need to look into. How old are those receivables and are we having issues collecting those? Other things to look at, investments. Okay, when we look at investments for current year compared to last year, how do they compare? How does that compare to the market? If the market tanked because of something going on in the economy, then I would expect our investments to go down. Or if the market went up because the opposite happened, then our investment should go up as well. As far as fixed assets, we need to understand when we need to replace those. So fixed assets don't last forever. Again, they're going to be depreciated so let's say you don't get any new fixed assets, but you just use the ones that you have, that number is going to dwindle down and down and down every year. The question there is, do we have some kind of schedule in place that we know how and when we're going to replace those fixed assets? Because it's going to cost money for you to replace fixed assets. So we need to be able to be prepared for that and know when that's coming. Are we going to pay for it with our own money out of operations? Are we going to have a capital campaign? Are we going to try and go for grants to pay for those? Or maybe we're going to have to take a loan out. So we really need to know when we need to replace those fixed assets and how we're going to pay for those, because we don't want to have any kind of lull in our operations when the time comes to replace those. Let's see what else. I think, again, that's beneficial interest, endowment funds, investments. Those are kind of similar to what I've already talked about. So again, how much cash do we have? Are we having any trouble collecting contributions? Investments compared to the economy? How are our fixed assets? Again, this total assets is kind of what your organization owns. We want to have a strong amount of assets to show what we own. Next section under the first statement of financial position, this is our liabilities. So again, the first column is 2024, second column is 2023. So when we look at liabilities, again, this is money that we owe to other people for services they've provided, for items that we've purchased, and we just haven't paid them yet. So the first line here is accrued wages and withholdings. So this represents payroll for people that have worked through December 31st, but haven't gotten paid yet. So normally your payroll doesn't fall on the exact December 31st and there's no accrual. It may, but that's usually not how it happens. So again, this would be the liability that the organization owes to employees that have provided a service. They have worked for the organization and just haven't gotten paid yet. Also, it would include a vacation, if they've earned that vacation and haven't taken the vacation yet. Payroll withholdings, those amounts that you withhold from their paycheck that you have to remit on. The next line here is accounts payable. So this is kind of the opposite of accounts receivable. This is for items that the organization has either purchased or received a service for during this period as of December 31st, and they haven't paid it yet. So you've received the service, you've received the amount, you have to pay it, you just haven't paid it yet. Other items that you might see under the liability section could be a line of credit. A lot of organizations have a line of credit that is available for emergency uses, or if they need it to cover the operations. You might see loans. It's not common, or it's common for organizations to have to take out a mortgage if they're going to buy a new building or if they need additional funding. Again, we talked about leases. So the opposite, you might see a right of use or a lease liability for either financing or operating leases. The other item you might see on here is deferred revenue. So deferred revenue is, again, kind of the opposite of prepaid. Deferred revenue occurs when someone has paid the organization for a service, not a contribution, but for a service that the organization is going to do, they're going to provide, but yet you haven't provided that service yet. So they've basically paid you in advance. And so since they've paid you in advance, we kind of have to set it in this separate holding account until we've actually provided that service, and then we recognize that as revenue. So when we're looking at liabilities, what do we want to look for? Similar to assets, we want to compare current year to prior year. Has it gone up or has it gone down, and why? Maybe we took out a new loan this year, so we should see that large loan balance on there that we didn't have last year. We want to make sure as far as accounts payable that we're not getting behind in those. So similar to receivables, if accounts payable keeps going up and up and up, why? Are we behind in our payments? That's not good. Or maybe maybe it's due to a timing, and there's a timing issue at the end of the year. We got an invoice in later than normal. We just didn't have a chance to pay it. So those variances, we need to find out why. The next section of the statement of financial position is the final section, and it's your net assets. In the for-profit world, it's called retained earnings. So again, we have 2024 in the first column, 2023 in the second column. And for nonprofits, we divide net assets into without donor restrictions and with donor restrictions. So with donor restrictions, let's talk about those first. That is from money or promises to give that donors have given to your organization for a specific purpose or a specific time period that haven't been spent yet. So if you didn't know, donors can make contributions to nonprofits, and they can say, please spend this contribution on this program, or please spend this on next year's operations. So when they do that, it's called restricted money with donor restrictions, and the organization needs to make sure that that money is actually spent for those purposes. Now, the other money that we receive that has no donor restriction is called without donor restriction. That's the money that we can use for our daily operations. That's what we like. Now, we do like restricted money, but we really, really like without donor restrictions because we can use that for whatever we want. When we're looking at our net assets section of this statement, we want to make sure that without donor restrictions is positive. If it is a negative number and we have a with donor restrictions as a positive number, that is not good. That means that we have borrowed against our donor restricted money. That means we have spent donor restricted money for operations, and we do not want to do that. That is not something that we want to do. So we want to make sure that, again, that without donor restrictions is a positive number. And we really like that number to be more than with donor restrictions, because again, I said that the without donor restrictions can be used for operations to pay for our daily expenses, which we have to pay for, versus our donor restrictions that are specific purposes. Now, in the nonprofit world, the board can also designate money that has been received without donor restrictions for specific purposes. So we use a different terminology there. When the board sets money aside, it's called designated. But when an outside donor, that's called restricted. Those board designated funds show up in that top line, that without donor restrictions. And the board can do this just through a board meeting, taking a vote and saying they're going to set money aside for a specific purpose, maybe for an upcoming capital campaign, maybe for a reserve. That's fine that they can do that. Probably should have a written policy in place. So if you do that, you want to make sure that policy is in place. So that's kind of what we look for under our net asset section of this statement. So I wanted to throw some just common misunderstandings that I've heard regarding the statement of financial position. One thing, we have cash. We have a large balance of cash. So that means we're fine, right? No, not necessarily. Or, hey, we have a large balance of cash and we can spend that on whatever we want. No, that is not necessarily the case either, because like I just said, sometimes you get money that's restricted for a specific purpose, and you have to set that money aside and it can only be used for that specific purpose, which means we can't use it to pay for our daily operations. Or we have a building or a lot of assets, so we're strong. That's awesome. We're going to be fine. Well, yeah, that's nice that you don't have to pay rent, but you can't pay payroll with a building. So there could be a liquidity issue there. So again, just because we have cash, we have a lot of assets, doesn't mean that we necessarily are good and where we need to be. Okay, let's move on to the next statement, the statement of activities. So again, the statement of activities is common to an income statement in the for-profit world. So unlike the statement we just looked at, which was for one day in time, the statement of activities is for a period of time. So this one that we're looking at here is for the total year, the 12 months ended December 31st. So the activity on this statement is from January 1, 2024 through 12/31/2024. Full year, we're looking at full 12 months of activity. We have 3 columns for 2024. The first is without donor restrictions. So again, what we just talked about, money coming in that can be used for whatever we want to. Next, with donor restrictions. That is the column that shows money coming in that has to be spent for a specific purpose per the donor's request. And then we have 2024, which is the total of these two. And this statement just also shows a comparable of 2023. So when you're looking at 2024, you have something to compare it to. When we look at the statement, the first section is basically our income, support revenues and gains. Then we have expenses. Oh, and as far as expenses, nonprofits are required to show expenses by function. A function is program, administrative, or management, general, and fundraising. And we'll talk about that a little bit more, but that's why you see the program expenses, administration, and fundraising. And then we also have change in net assets, which is basically your net income. And then we have the net assets at the beginning and the end of the year. So when we look at this statement, we really want to look at the first column there without donor restrictions that's kind of what our operations. So this one has a change in net assets of $339,930. So that means basically on our operations, we brought in net income of $339,930. The second column with donor restrictions, that has to do with timing differences of when those items came in and when they're spent. So if we look again at the top section, just total support and revenue, we're going to show our various types of revenue that we come in. that we get. So contributions, grants, our special events, program service fees. Again, if you're providing some type of service, you would have some fees that you're receiving, other income, and then our investment income. So if your organization is 100% supported by contributions, you might just have one line here that says contributions. If your organization gets money from these other different sources, you're going to have more lines. What you want to look at when you look at this statement is, first of all, where are we getting our revenue from? So we want to make sure that we have some kind of diversification of revenue, because if we are relying completely on one revenue source, or more likely one donor, and that donor or that revenue source goes away, what's going to happen to our organization? Will we be able to survive? So when you're looking at your financial statements, you want to figure out, where are we getting our revenue from? You also want to know when we bring that revenue in, if it is, there's a risk that nonprofits might have unrelated business income. So especially during the pandemic, organizations look to find new ways to get revenue, new ways to get support, which is great. Sometimes when organizations have new funding streams, and those funding streams do not relate to their mission, doesn't matter that the money is going into the mission, but if it doesn't relate to their main mission, it could be considered unrelated business income. I'm not going to go into that a whole bunch here, but I just want you to know that nonprofits, if you have unrelated business income, you do have to pay taxes, unrelated business income tax on that income. That is completely fine. The IRS just doesn't like it if you have too much unrelated business income. Organizations do not pay income taxes, but they do pay unrelated business income tax on that unrelated business income. So my point is that when you're looking at your financial statements, if you see new revenue sources, you might want to inquire what is generating those, and do we have any risk of having to pay unrelated business income? So back to the statements. When we look at without donor restrictions and with donor restrictions, think of it as your pockets, your right and left pocket. So basically, our without donor restrictions is the money we put in our left pocket. The with donor restrictions is the money we put in our right pocket. So when money comes in that a donor says it has to be restricted for a specific purpose or period, we're going to put it in our right pocket with donor restrictions. So in this current year, we received the 696, the 404. That was money that was coming in. We're going to put it in our right pocket because the donor said we have to spend it for a specific purpose. So then when we spend that money, we're going to take it from the right pocket and we're going to put it in the left pocket. And that's what that net assets released from restrictions is. That's why that nets to zero, because all we're doing is saying, okay, it's time to spend this money that's been restricted because that restriction has been met. So we're going to move it to the right pocket, from the right pocket to the left pocket. So it's not like we're adding $1.2 million. We're just moving it from one pocket to the other. And then when we spend it, we pull that out of the left pocket, because expenses can only be paid out of the left pocket. So hopefully that kind of gives some additional explanation on with and without donor restrictions columns. Now, the other thing here is that sometimes when you look at this, you want to make sure that you understand what those with donor restrictions are for. Because if you have a lot of money that a donor has set aside for a specific purpose, and maybe you're not doing that program anymore, or maybe that's a very, very small program, are you going to be able to spend that? Because again, we have to follow the donor's wishes. So we want to make sure that we can spend that, and so that we have those expenses. So making sure when we look at this, what are those restrictions for? And are we getting too much donor restriction money? Because we have to, get money to pay for operations. When we look at the second part here, we see the expenses. And again, I noted that they're allocated between function, program, administration, and fundraising. So you can see that there. And then we also have expenses. Again, we're only paying expenses out of the left pocket. That's why it's only out of the without donor restrictions column. Now, so when we look at this with donor restrictions, again, I just want to say one other thing, that sometimes this column right here, this 86,401, sometimes that's negative. And that could be a timing difference, because sometimes we get money, this 1.2 that we respent this year, sometimes that's not money that has been received in the current year. Sometimes that's money that has been received in the prior year. And because of restrictions, we haven't been able to spend it until the current year. So this with donor restrictions could include expenses for amounts that were received in a prior year. So your revenue and expenses will not always match up, and that is okay, and that's how it is in the nonprofit world. So expenses, revenue, change in net assets is basically your income, your net income for the year. So we like that first column to be positive number. If not, that means that we have spent more than we have brought in during the year. Sometimes that happens, but we really like that to be positive. Some common misunderstandings related to this statement. We made a profit, great, we're doing great. Or the opposite, we have a deficit, something is wrong. Again, that might be going back to the timing differences. Maybe we got a large amount of restricted money in a prior year, but we have to spend it this year. So again, revenues and expenses are not going to match up. All revenue is equal. That is not the case. Again, because sometimes contributions are restricted for a specific purpose, and so we have to use them for that purpose. Or maybe that revenue, yes, we recorded it as revenue this year, but we're not going to be able to spend it until next year. Or maybe we're not even going to be able to get it until next year. And again, expenses should match revenue, which is just not the case in the nonprofit world. And I know people from the for-profit world, that probably drives them nuts, but that's not how it works in the nonprofit world. Also, you want to think about when you're talking about your funding and your revenue, where you're getting that revenue is from, you want to be aware of those one-time grants. So those non-reoccurring revenue versus the reoccurring revenue, because those one-time grants, they're only going to happen that one time. So if that goes away next year, is there going to be something else to replace that? Next is the statement of functional expenses. So this is the statement that for-profits do not have, but nonprofits do. What this does, well, let's start off here. This again is for a period. So it's very similar to the statement of activities that is for a period. So this is for a whole year, 12 months, January 1st, 2024 to December 31st, 2024. We have the different functions. So this shows the three functions: program, services, administration, sometimes it's called management in general, and fundraising. If you have more than one program and they're like significant differences, you might see more than one program. You might have an education program or a transportation program. So you might see more than one program. But the requirement is that all expenses have to be allocated by function. So program, management in general, and fundraising. And then we have the total for the year 2024. And this statement also shows 2023, so you can have some comparison. So when we look at this statement, again, the function is the purpose of the expense. So what function does it fall under? Program function are those expenses that are related to providing your program. So it could be the salaries for those people. It could be the supplies that you need for that program. It could be a portion of your occupancy expenses, your rent and utilities, that program is being used or served in the building. Administration, management in general, those are expenses that you have to have because you're running an organization. No matter what kind of program you have, you're going to have these expenses. So that's going to be your payroll fees to have somebody run your payroll. That's going to be your accounting fees if you're outsourcing that. That's going to be your audit fee. That's going to be your bank fees. Those fees that are related to just kind of general business operations. And then we have fundraising. Fundraising are those costs that that you incur to have somebody give to your organization. So it could be your special event expenses. It could be your mailer that you put out to ask for money. And there needs to be a reasonable method on how to allocate these expenses across these functions. So for example, salaries. That's a very common and kind of an easy one. Normally, salaries are allocated based on how much time individuals spend in each one of these functions. So in a nonprofit, a lot of times people wear different hats. So an executive director might have some time spent on program, some time spent on just management running the organization, and some time on fundraising. So whatever percentage they have spent on each of those areas, that is how their salaries get allocated. If you don't know that, I would recommend doing a time study for your people to see how much time they're spending in these different areas. Organizations that have are very young, that are just starting off, are going to have higher admin and fundraising percentages. Those organizations that have been around longer are probably going to not have maybe as many administration and fundraising expenses, more programming, because the programs have been set up. Those organizations that are going through a capital campaign are going to have a whole lot more fundraising, and that's how it should be. When you allocate these expenses, there needs to be a reasonable basis, and it needs to be consistently applied. A reasonable basis, like I said, could possibly be time spent. It could be square footage on those occupancy related expenses. It cannot be budget by budget, and it cannot be by revenue. So just keep that in mind. And best practices say 65 to 70% of your expenses should be on program services, and then the remaining on administrative and fundraising. And then also this is the same schedule. So we went across, and now we're going to look down. So when we look down on the left-hand side, these are our natural categories. So this is the actual type of expenses. Is it a salary? Is it a supply? Is it travel? That's where we want to list these expenses. So when you're looking at your statement, you want to see, okay, do these properly reflect our expenses that we have? And do they give enough information to the reader of what we're spending our money on? But we don't need to go down into the details. So again, here's a definition of those different functions that we talked about. Talking about allocation of expenses. Again, some of those expenses are going to be direct. Like for example, you might have travel, and that is 100% administrative and general always. So that's very easy. It goes into travel. Where a lot of the expenses like telephone, rent, those insurance, those kind are going to be allocated across each of the three functions. And so we need to figure out how we're going to do that. And it needs to be some kind of reasonable basis in place. When we look at the statement of functional expenses, the most common thing that people look at is low overhead equals a good nonprofit, which means we want to have as lowest overhead, lowest amount of admin as possible. That is not true. Low admin can mean that the organization is under investing, and a strong organizations actually invest in their infrastructure. So there should 100% always be some admin and fundraising. Fundraising is also an investment. Growth often requires higher upfront fundraising costs. So if you have contributions, then you should have some fundraising costs. Allocations are exact. That is not the case. It needs to be looked at every year to see if there's any changes, if there should be any changes to the allocations. The final statement is a statement of cash flows, and I'm probably going to spend the least amount of time on this. If you do your own internal financial statements, you likely do not have a statement of cash flows. But if you have an outside audit or review done, this is one of the statements that would be included. Just like the other two statements that we looked at, the statement of cash flows is for a period. So it is for 12 months ended 12/31/2024. We have 2024 and we have 2023 because again, we want to be comparative. We have three sections here. We have the cash flows from operating activities. We have cash flows from investing activities, and we have cash flows from financing activities. So all of the activity is divided between these three different activities. And then we have the cash at the beginning and the end of the year. So when we're looking at this first section is cash flows from operating. We have 2024 in the first column and 2023 in the second column. So what we want to look at here, this is basically adjusting the accrual basis to the cash basis. So what this says is that during 2024, we used $449,000, almost $450,000 in operations. So money was used. We like to see this number being positive. However, sometimes it's not. So for example, here, this top number, our 426,331, that's basically our net income. Well, our net income includes $906,852 of gains on investments. That's not real cash. So if we take that out, that flips it to a loss. And so that's where that loss comes from, where we brought in less money than what we spent during the year. So when we're looking at cash flows from operating, we really like that to be a positive number, but there's reasons why it wouldn't be. Next is cash flows from investing activities. So this is money that we're investing into our organization, whether it be purchasing fixed assets, maybe we're putting cash into investments. So we're investing in the organization. So sometimes we do that. We buy a lot of fixed assets in a year, or we put a good chunk into investments, and that's fine. This year, we actually got money out of the investing because of the sale of investments. And then our cash flows from financing. This specific one just has the cash contributions restricted for long-term purposes, because those money coming in or set aside for a long-term purpose. So that is going to pay for those, fixed assets in the future. But sometimes there could possibly be, like, if we have a loan, the loan proceeds are going to be here on this financing activities as well. What we want to look at on this statement, again, is where our money is coming from, where it's going, and we want to make sure that our cash at the end of the year is positive. So some common misunderstandings on this statement is, well, we had a surplus, so obviously cash should increase. Well, that doesn't necessarily mean that, because if your financial statements are on the accrual basis that show a surplus, cash doesn't always coincide with that. Or cash went down, so we're in trouble. No, not necessarily, because maybe we're spending some money and investing into our organization. Or the timing of the money coming in for those restricted multi-year grants. Loans and capital purchases don't matter much. Yes, they do, because obviously that is investing into our organization. Sometimes we need to see what that's being used for and how we're using those. So those are the 4 statements. So when we're looking at those 4 statements, we kind of talked about some of the questions to ask. But these questions here basically work for every statement that we're looking at. So what is the story this statement is telling? On the statement of financial position, it's one day. So it's showing us our assets, our liabilities, and our net assets. What is this telling us about our organization? What has changed since last period? So that's why we always like to see 2-year comparative, current year versus last year to date. So did it go up or did it go down, and why? And sometimes it's okay to have large variances, but we need to know why. And if we're not asking that question, then we're not doing our due diligence as board members. And then what could go wrong if this trend continues? So for example, if we're having issues collecting on our receivables, what if we continue to have issues collecting on our receivables? What is that going to do to our cash flow and our cash balance? And then finally, what decisions do we need to make because of this, of what we are seeing? Do we need to change how we're doing something? Do we need to, again, back to the receivables, do we need to implement some new policies on to better, more timely go and ask people to collect those receivables, so that can result in better cash flow for us? So those types of things. So when you're looking at those statements, these are 4 questions that can really relate to each one of those statements. Nonprofit financial statements tell an organization's story. They just use numbers. So it talks about your mission, your activities, and your financial health. Really, it's just in numbers. So you have to interpret those numbers to figure out what the story is telling you. For-profit businesses, their statements focus on profitability. That's, how much money did we make? How much taxes are we going to have to pay this year? Nonprofits use their financial statements to demonstrate how they're using resources to fulfill their mission, because I know you have lots of funders asking for financial statements. Your board looks at financial statements. The IRS, in an indirect way, looks at it when you report those numbers on the 990. You have a lot of people looking at your financial statements. Financials don't exist to prove you're fine. They exist to help you govern before you're not. So again, as a board member, it is our duty to look at those financial statements every month and also ask questions. Please, if you have a question, more than likely someone else has a question as well. This final section, I know we only have like 5 minutes left, so I'm not going to go through each one of these, but I wanted to give you some information on KPIs. And when you're looking at KPIs, I just want you to remember a few things. no single KPI tells the whole entire story. So for example, you could have a high program ratio. So, your expenses, you could have a lot of 90% of your expenses could be on program, but you might don't have any cash. So you can't look at just one KPI. When we talk about benchmarks, so for example, the 3 to 5 months that you should have on cash on hand, those are guidelines. Those aren't rules. There's no requirement that these have to be met. They're just kind of, hey, this is what most, strong organizations have. A startup nonprofit is going to look very, very different than an organization that has been for a very long time. And also an organization that, is an arts organization or a human service organizations versus a private foundation, they're going to look totally different too based on their activity. So remember that when you're looking at KPIs. Trends matter more than snapshots. So KPI is, again, a snapshot. It's just one piece. You need to look at the trend within your organization over time. And then for most nonprofits, it's better to track a small number of KPIs consistently versus a whole bunch. There are all kinds of KPIs out there, all kinds of ratios that you can use, but we really don't want to do that. That is not going to be beneficial to your organization. You need to find those that are going to be helpful to your organization, also those that are related to your organization. If you don't have any kind of program service fees, then you don't need to track any KPIs that relate to program service fees. That's not going to be helpful. So what I would recommend is focusing on, maybe 5, 6, 7 KPIs. Find the ones that provide you some helpful information about your organization. Focus on those and start tracking those. So I have included these next slides. And again, I'm not going to talk through each one of these, but I have included some different KPIs that I think are beneficial to nonprofits specifically, and that can help you evaluate some of your numbers from your financial statements. The first one, program expense ratio, as you can see, each slide will show the calculation. So how you calculate it, what it actually is showing you, and then also the benchmark. And again, benchmarks, there's a guideline. You don't be extremely worried if you're not within the benchmark, but it's just kind of something. Someone always asks, well, what's a good number? So something to provide you with that. So talked about program expense ratio, fundraising efficiency, operating margin, months of cash on hand, which we talked about, the current ratio, revenue concentration ratio, which we talked about, the public support test. Oh, I do want to talk briefly, really, really fast on this. The public support test, those organizations that are a public charity versus a private foundation, you need to make sure that you are aware of how much money you are getting from public sources, because if you fall below the 33.33% for public support, you're going to become a private foundation. You do not want to become a private foundation if you are a public charity. You have to pay excise taxes, and there are additional rules and regulations that you have to follow. So this is a very important one that you need to be aware of. Then we have earned revenue ratio, budget variances, cost per outcome or cost per client, donor retention rate, average gift size. So there are some in here that aren't directly related to your financial statements, but I think they do provide some additional support. Staff turnover rate. So again, those are not all KPIs. I just think those are some really good ones that if you want to start with somewhere, that's a good place to start. So I think that's pretty much the end of our time today. Thank you so much for attending. I wanted to just provide this last slide that has some resources for you. If you're not familiar with our website or haven't visited, I encourage you to visit our website. We have, you can sign up for our future webinars. You can access recordings of our prior webinars. We also have a blog that is specific to nonprofits that talks about all kinds of things that we think are important that you should know. And if you have any other questions, please feel free to reach out to any of our team members. We have our emails on that first slide. These slides will be emailed out to you afterwards, so you can have all of that information as well. Again, thank you for attending and all that you do for our community.